$1.2 million sneakers sold. $400 billion secret market. You just saw a pair of sneakers sell for $1.2 million. But here's the part they didn't tell you: this isn't an anomaly. It's a pattern. Since 2020, the collectibles market has grown 12% year over year. The S&P 500? Just 8%. And that's not even the most shocking part. These assets, wine, watches, cards, aren't just holding value. They're outperforming. Why? Because they don't move with the stock market. When stocks crash, rare assets often don't. That's a game changer. Take this card. Sold for $12.6 million in 2022. But here's the twist: it's not just about money. It's about culture. People don't just buy assets anymore. They buy stories. And stories? They're scarce. Scarcity drives demand. Demand drives value. But here's where things get interesting. The Knight Frank Index shows wine up 132% over the last decade. Watches? 165%. Meanwhile, the S&P 500? Just 147%. So why isn't everyone doing this? Because there's a catch. And what I'm about to show you will change how you think about wealth forever. Since 2020, the S&P 500 has grown 47%. But sneakers? 20% annualized. That's not luck. That's math. Point number 1, rare sneakers. StockX data shows the Jordan 1 Chicago resale price jumped from $2,000 in 2019 to $12,000 in 2025. But here's the kicker: this isn't just hype. It's a $10 billion market. Point number 2, luxury watches. A Rolex Daytona once sold for $17.8 million at auction. But even entry-level models like the Submariner deliver 8 to 12% annualized returns. Therefore, if you think gold is safe, you're missing the bigger picture. Point number 3, fine wine. The LivX Fine Wine 1000 Index has outperformed the FTSE 100 by 15% annually since 2010. But here's what nobody tells you: wine isn't just for drinking. It's a hedge against inflation. Point number 4, trading cards. A 1952 Mickey Mantle card sold for $12.6 million in 2022. But even modern cards like Pokemon are crushing it, 18 to 25% annualized returns. Therefore, if you're still buying bonds, you're leaving money on the table. Now, you're probably thinking, what's the catch? Liquidity. Storage. Authentication. But here's the twist: these aren't problems. They're barriers to entry. And barriers mean opportunity. So who's making real money in this market? The answer might surprise you. But that's a story for the next segment. You asked who's making real money in this market. Meet Alex. At 25, he turned $10,000 into $1 million, not with stocks, not with crypto, but with sneakers. But Alex isn't alone. The ultra-wealthy are quietly diversifying into rare assets, sneakers, watches, even vintage wine. I saw the data. The demand was there. I just had to act. And now, institutional investors are stepping in. But here's the question no one's answering. How do you actually invest in rare assets? You saw the numbers. 20% annualized returns. But how do you actually invest in rare assets, without losing your shirt? That's what we're breaking down right now. Here's the first rule: collectibles aren't stocks. They don't pay dividends. They don't grow on trees. Their value comes from one thing: desirability. Take this card. Only 60 graded PSA 9s exist. That's a 10,300% return. But here's the catch: most cards from that era are worthless. Why? Condition. And condition is everything. Therefore, Rule number 2, authentication isn't optional. This is a PSA grader. He doesn't just look at cards, he measures corners to the micron. No certificate. No sale. Because fakes are everywhere. Here's what to look for. 1. Font inconsistencies. 2. Print quality. 3. Paper stock. 4. Hologram placement. Miss one. You're holding a $500 paperweight. But authentication alone isn't enough. You need provenance. These shoes sold for $1.47 million. Why? They came with a letter from Jordan's equipment manager. No letter. $50,000. Now, here's where most investors go wrong. They bet everything on one category. Big mistake. In 2022, the sneaker market dropped 30%. But rare watches? Up 18%. Therefore, rule number 3, diversify. This investor. He lost 12% on sneakers but gained 25% on watches. Net. 13% up. But not all marketplaces are equal. eBay. 1 in 5 sneakers are fake. Sotheby's. Less than 1%. Rule number 4, buy from trusted sources. And here's the part no one talks about, liquidity. Stocks. Instant. Collectibles. Sometimes months. Therefore, rule number 5, only invest what you can afford to hold. Now, let's talk about the biggest risk no one sees. What happens when the market shifts, and your $10,000 card is suddenly worth $2,000? That's next. You ever meet someone who had it all, and then lost it in a heartbeat? This is Daniel. In 2023, he was worth over $500,000. Not in stocks. Not in real estate. In rare watches. Signed baseballs. Limited edition sneakers. But here's the thing no one told him. Daniel didn't lose his money in a market crash. He lost it to fakes. Every single piece he bought, certified, authenticated, or so he thought, turned out to be a counterfeit. But here's where it gets worse. He didn't just lose the money. He lost the ability to sell. Rare assets aren't like stocks. You can't click a button and liquidate. You need a buyer. And when the market smells blood, buyers disappear. Daniel's collection was worthless. And even if it wasn't, no one was buying. I want you to imagine this for a second. You've spent years building something. You've sacrificed. You've dreamed. And then one day, you wake up, and it's all gone. Not because of a recession. Not because of bad luck. But because you didn't see the risks hiding in plain sight. Now, here's the question I need you to ask yourself. Because Daniel's story isn't unique. In 2024, over 30% of high-value collectibles sold at auction were later flagged as fakes. And in 2025, that number jumped to 42%. But here's the thing. Daniel's mistake wasn't trusting the market. It was trusting without verifying. And that's the loop we're closing next. Because if you're going to play this game, you need to know the rules. And the first rule. You want the glitter of rare assets. The 20% returns. The prestige. But here's the truth no one tells you, this market is a minefield. Daniel thought he was safe. He wasn't. The counterfeit market isn't just big, it's a $3 trillion monster. That's larger than the GDP of the UK. And it's growing. Fast. In 2022 alone, 1 in 4 rare assets sold at auction were fakes. Not misprints. Not overpriced. Outright forgeries. And if you're not careful, you're next. But here's where things get worse. Even if you buy the real thing, you can't just stuff it under your bed. Storage costs $5,000 a year for a mid-sized collection. Insurance, another $3,000. And that's if nothing goes wrong. Liquidity is the silent killer. You think you can sell anytime? Try selling a $500,000 comic book when the market tanks. The average rare asset takes 6 to 12 months to sell. And in a crash, you're lucky to get 30 cents on the dollar. Insurance won't save you. Lloyd's of London, the gold standard, won't even cover assets over $10 million. And if they do, premiums can eat 2% of your assets' value. Every single year. But here's the part no one talks about. The market doesn't just crash, it disappears. Daniel lost everything in 18 months. Not because he was reckless. Because he didn't see the traps. So how do you invest in rare assets without getting crushed? That's what we're covering next. But first, there's one risk even the experts miss. You want the truth? The financial world is at war. On one side, the suits. Warren Buffett's voice booms from the screen, calling collectibles a speculator's playground. But on the other, Ray Dalio, billionaire hedge fund king, smirking as he drops a gold bar onto a table, tangible assets are the ultimate hedge. So who's right? Let's start with the numbers. Over 3 decades, the S&P 500 delivered a 10.7% annual return. Rare coins, 11.9%. But here's the catch, that 11.9% is an average. In 2008, the collectibles market crashed 30% in 6 months. No bailouts. No FDIC. Just you, holding a $50,000 comic book worth $500. Remember Daniel? He bet everything on safe assets. But the market didn't care about his story. It cared about liquidity. And collectibles? They're the least liquid asset on earth. Critics say this is gambling disguised as investing. Supporters call it diversification. But here's what no one admits, the real danger isn't the market. It's the hype. In 2025, 62% of collectible purchases were made by first-time buyers, most under 35. They didn't buy for value. They bought for clout. And clout? It's the most volatile asset of all. So are collectibles investments? The answer is yes. And no. They're a high-risk, high-reward bet on human psychology. But here's the question that matters, because if you don't know the rules, you're not investing. You're just hoping. And hope is not a strategy. You remember Daniel. He lost everything because he treated rare assets like a lottery ticket. But here's what no one told him, there's a playbook. A way to step into this world without stepping on the mines. Let me show you how the smart money does it. First rule, start small. BlackRock doesn't dump billions into untested markets. Neither should you. Allocate just 5 to 10% of your portfolio to rare assets. That's your sandbox. Your lab. Your place to learn without getting burned. Therefore, if the market turns, you're not wiped out. You're just adjusting. Second rule, blue chip assets only. You want things people will always want. Not fads. Not hype. Real, tangible demand. Quick cut, expert interview, financial advisor in a sharp suit. I tell my clients, if you can't explain why an asset has value in 10 seconds, walk away. Back to host, therefore, focus on assets with proven track records. Think Rolex Submariners, not Beanie Babies. Third rule, dollar cost averaging. You don't time the market. You time your discipline. Every month, you buy a little. When prices dip, you get more for your money. When they rise, you lock in gains. But here's the kicker, most people do the opposite. They buy high, sell low, and wonder why they lose. Fourth rule, track trends like a hawk. Set alerts. Follow auction houses. Know when to hold and when to fold. Therefore, if you see a Picasso selling for 30% above its last auction price, ask why. Is it a bubble? Or is demand surging? Micro hook, but here's where things get interesting. What if I told you the real playbook isn't just about what you buy, it's about how you think? The smartest investors don't just follow trends. They anticipate them. They look at macro forces, demographics, technology, cultural shifts, and they position themselves before the wave hits. But, and this is critical, this video is for educational purposes only and does not constitute financial advice. Always consult a qualified financial advisor before making investment decisions. Therefore, if you're serious about rare assets, you need to think like an institution, not a gambler. Now, let's talk about the future. Because the next decade isn't just about gold or watches. It's about assets we haven't even considered yet. Open loop, what if the rarest asset of 2030 isn't a thing at all, but a digital key? But that's a story for another segment. For now, remember this, the playbook isn't about luck. It's about rules. And if you follow them, you won't just survive this market, you'll master it. You've seen the battles. The red versus blue. The suits versus the rebels. The old money versus the new. But here's the question no one's answering, what's the future of rare assets? You think this is about baseball cards or rare coins? No. This is about power. The financial world is being rewritten, and collectibles are the ink. Here's the revelation, wealth building isn't just for the elite anymore. In 2025, 42% of high net worth individuals under 40 held digital collectibles. That's not a trend. That's a revolution. But why now? Because the system is broken. When currencies fail, when stocks swing like a pendulum, people turn to what's real. What's rare? What can't be printed or hacked? And the market is evolving. OpenSea isn't just a marketplace. It's a battleground. In 2026, the global collectibles market hit $1.2 trillion. That's larger than the GDP of Spain. This isn't just about owning something. It's about proving it. Blockchain doesn't lie. But here's the thing, this isn't financial advice. This video is for educational purposes only and does not constitute financial advice. Always consult a qualified financial advisor before making investment decisions. So what's the one thing you need to know? The future isn't coming. It's here. And it's rare. You've seen the numbers. You've heard the stories. But here's the one thing no one tells you, rare assets aren't just about the money. They're about the hunt. The story. The legacy. Wait, what? That's the equation. Scarcity drives value. Culture drives demand. And when you combine them, you don't just own an asset. You own a piece of history. But here's the catch, most people get it wrong. They chase trends. They panic sell. They forget the golden rule. This isn't Wall Street. There are no quarterly earnings. No CEO tweets. Just time. And discipline. Look at that. Decades of value. Not months. Not weeks. Decades. So what's the playbook? First, buy what you love. Not what's hot. Second, hold. Even when the noise gets loud. Third, build a network. The best deals happen in private. And remember, this video is for educational purposes only. It's not financial advice. Always consult a professional before you act. Now here's the truth. Rare assets aren't for everyone. They're for the patient. The disciplined. The ones who see beyond the price tag. Because when you master this, you're not just investing. You're curating a legacy. And that's how you win. You've seen the past. You've dissected the present. But the future? That's where the real game begins. What's the next rare asset that'll 10x in value? Next week, I'm breaking down the exact blueprint, no fluff, no hype. Just the assets, the trends, and the moves you need to make. Subscribe now, this is how you stay ahead. Next week. Cut to black.